On the Express this week, welcome to the New World Order, the United States crude play in Venezuela. We play some offense defense inside the stock market, and Liz Thomas of SoFi drops in with her playbook. It's the flow show for ETFs, which are coming off of a banner year. And what in the world are we going to do without Warren Buffett? From the Paseo de Peralta to Ojo Caliente, it's the Investopedia Express, live from Santa Fe. Welcome back and welcome aboard. There we go, live from Santa Fe, New Mexico. It's the Santa Fe Express right there, my hometown, coming to you from the Southwest. Happy New Year to all and happy new moon. Wow, we are in for a new world order. So much going on, so much to talk about right now. We got the U.S. invasion of Venezuela to talk about what that means for the oil market, what that means for the rare earth market, what that means for defense stocks and oil stocks. It is the beginning of more U.S. imperialism, and this will definitely change the world order. We're going to talk about the stock market in general, which is coming off of another great year. Now, year 4 of a bull market, and we know what has propelled this bull market so far, but what happens from here? Where do we go from here? We're going to get into that with our friend Liz Thomas of SoFi in just a few minutes. The AI theme, though, alive and well, but kind of frothy, but leaving us questioning, where do we actually go from here? Shout out to all of our live viewers from around the world. We got Kush Konar in the house. We got Frank Foster in the house. Thanks so much for joining us. Join the conversation from wherever you are, all over the world. We know the Investopediacs are everywhere on the planet, and we love the fact that you're tuning in. Drop your comments, drop your questions. We will get to as many of them as we can. Of course, live every Monday here on the Investopedia Express, and then on all platforms on demand. But we got a lot to talk about right here. So drop your comments, drop your questions, and let's tune in. Let's bring in our friend Liz Thomas, the head of investment strategy at SoFi, on the drop-in, because we have a lot of questions about her outlook for 2026 and what to do now. Hi, Liz. Thanks so much for joining us. Happy New Year.
Hello. Happy New Year to you.
I've been looking forward to this conversation. Got your note just as the year ended when you literally started off by saying we are quite literally witnessing history just for the strength of the stock market and so many things that are going on. I want to get to your outlook for 2026, but because you are the head of investment strategy at SoFi, how do you react and how does your team think about the developments in Venezuela over the weekend and at the end of last week? And I know you haven't made any major declarations or thesis yet, but how do you process this kind of information?
Well, let me start by saying when I opened the outlook by saying we are literally witnessing history, I did not anticipate this Venezuela thing. So this was a surprise to us. A couple of things that I would point out. So this is the first trading day that we have markets open after the events that occurred over the weekend. Some interesting things going on. So first and foremost, you would think that the energy sector would be either at the top, at the bottom, something notable in the sector lineup for the S&P, but it's right smack dab in the middle. Best sector as of right now in the S&P is financials. So what we're seeing in markets, if we look at just the ranking of those sectors, sector returns, we've got financials, consumer discretionary, industrials, and comm services as the top 4 performers right now. Markets are saying that this is perhaps cyclically positive when we're looking at cyclical sectors responding. In contrast to that, however, we also see one of the best performers in the market today as gold. So this appetite for gold that investors have had did not go away because of this conflict. And I think that's just further support that there are a number of different use cases for investors seeking gold. Obviously, there's been a lot of economic nationalism, there's been a lot of currency volatility, but now we've got more geopolitical risk and uncertainty and just looking forward of how does this change the world order? So people are looking at gold as, okay, maybe this continues to be the best place to protect myself from a lot of that volatility that doesn't seem to be slowing down anytime soon. The last thing I would say is that not only am I surprised that the energy sector is not making a more notable move, but what I want investors to be cautious of is that oil prices, although a little bit positive today, I think what we might see as a result of this conflict is that oil prices and energy stocks have a dislocation. So the opportunities that perhaps and we don't know enough about this yet, the opportunities that could perhaps present themselves to energy companies may be completely different from the activity and the action that we see in oil prices. So don't put those two together as highly correlated right now.
Yeah, great points all around. And that dislocation is super important. Plus the flight to gold, which was really a theme in 2025, despite the resilience of the stock market, which I want to get into with you. As you say in your terrific note, and folks will link to it in the show notes, the power of the AI theme really since 2022 persisted last year, even though there were doubts and concerns about a bubble, right? But it is driving, as you point out, economic activity and business productivity, which leads to positive investor sentiment. And kind of that's the recipe you need.
That's right. So the title of our outlook this year was "The Show Must Go On." And we meant that in a few different ways. And then there are some subsections. And I think maybe the most important subsection is called "Befriend the Bubble." So I am not qualified to decide whether or not this is a bubble, but regardless, we're going to continue to talk about it as if it is. So we might as well just get past the word. And if we are, in fact, in a bubble or watching one inflate, I think right now, especially in 2026, you're probably better off befriending it than you are trying to avoid it and being afraid of it, because not being present in this is probably the bigger risk. Now, we've seen 3 solid years in the chart that we're showing right now. We've seen 3 solid years of S&P returns. And what you see in that yellow bar, this is after a 3-year return of more than 80%, which is what we just experienced. The forward 1-year return is only about 5% on average. The forward 3-year return is only 7%. Point being, after we've seen such strong results, generally speaking, the forward returns are more muted. But I think the other important thing here is that they're still positive. And remember that this is for the broad index. Each sector is going to perform differently than those averages, and even each industry group is going to perform differently than those averages. We are so dependent right now on this AI theme for driving productivity, like you mentioned, and driving economic sentiment forward. So we need it to continue. We need the show to go on in order for the economy to continue picking up steam in the cyclicality for 2026.
Yeah, and more importantly, as you point out, we need the spending to go on, because it's the
Right.
capex spending that's driving the profit growth, which is driving the margin expansion. So as long as these companies continue to spend roughly what they've been spending, almost $400 billion in 2025 on the build out here, that's positive for earnings, which is positive for multiple expansion. And that makes sense, right?
Even more importantly, Caleb, it's positive for GDP growth because CapEx spending is a component inside what's called private investment. And when we look at GDP growth, and us that follow macro look at this really intently on a quarterly basis, what drives GDP growth is very important. It's not just that we've had 3 or 4% growth, it's what's driving that growth. What you want to see driving that growth is consumers and private investment, because that's really the underlying demand in the economy. The other things are imports and exports and government. Those are not the underlying demand components. So consumption has driven GDP growth. Private investment, which is where that CapEx piece is going to be falling, also drives GDP growth. So as long as CapEx stays strong, I think number one, it will start to encourage other companies outside of the tech space to engage in more CapEx, driving more GDP growth. We also have some stimulus in the form of tax rebates, tax changes, corporate tax changes in 2026 that should encourage CapEx growth as well. There is expected to be a little bit of a tick down in the absolute level of spending from AI companies, but I think that's okay at this point in the cycle. We don't want it to get completely unhinged, or maybe more unhinged than it already has. So there's going to be a little bit of a slowdown in spending this year, but investors are starting to demand that sort of capital discipline. They want companies to be more careful with the spending and show some results first. The
Yeah.
chart that we're looking at here from the Outlook is talking about basically the concentration that we've experienced in the market. And this is a topic that a lot of investors have been concerned with, and rightfully so. When you look at this compared to the Mag 7, the rest of the S&P, you've got in the lighter blue bars, this is actually the tech bubble. So the S&P infotech sector and the Mag 7 had returns of 185%, and then the rest of the S&P only 33%, but that was a little bit more spread out. When you look at what's happening in EPS, same idea. Right now, we've got a change in forward EPS of 100% in the Mag 7 plus the infotech sector, and the rest of the S&P really not driving much as far as earnings goes. So we have been really dependent on the tech sector and the Mag 7, not only to drive returns, but also to drive earnings. And I think that's a really important distinction. Now, does that mean that we're in a precarious position? It's a more precarious position than, let's say, if every single sector was doing really, really well. However, this chart, which is a great segue, yes, we still expect infotech to be the strongest performer from an earnings standpoint in 26, but look at the second and third sectors on this chart: materials and industrials, number 2 and 3. And materials not that far behind infotech, industrials a little further behind, but still those two sectors very cyclical in nature. And if this comes true, then we've got a market that's reflecting, again, a cyclical economy that has strength and growth in other places outside technology.
Yeah, and to your point, you mentioned in your note again, which we'll link to in the note, our show notes, looking for companies that are cash rich. That's important right now, but other sectors that could rally as a benefit of this, or just because of the cyclicality of growth here, are healthcare, materials, and staples, which did not really participate that much in 2025, just given the concentration and where the profit was. But back to your other point, the fact that we have this low debt to EBITDA ratio, which I know you're a ratio person, you're an indicator person. You look at that very closely. It's not that these companies are spending willy-nilly. They're actually producing profits, and their debt is relatively low and may even be benefited by the fact that interest rates are going lower and it's a friendlier tax environment for corporations, right?
Right. So the debt to EBITDA was a conversation that heated up towards the end of 2025. And that's because what we started to see was the group that we refer to as the hyperscalers, the AI hyperscalers, started to issue debt in order to finance some of this CapEx, finance some of their growth. And sometimes when companies start to issue debt or they start to rack up debt, it can be a warning sign that they're getting overextended. Maybe things have gotten a bit too euphoric and it changes basically their fundamental health because they have to pay interest payments. You don't want to see a company get too far indebted. So we started to look at net debt to EBITDA because we were really just trying to refute whether or not that was a true concern. So when you look at the hyperscalers or even the companies that we're calling the big 11, which is the Mag 7 plus AMD, Broadcom, Oracle, and Tesla, when you look at those, you've got net debt to EBITDA that's actually even lower than the overall index. So the debt that they're issuing, not a concern, at least broadly right now, but it is starting to pick up. Now, the other thing about net debt to EBITDA, and when companies start to issue debt, debt can actually be more efficient. It can be more effective than going to the equity market. And it doesn't mean that these companies are suddenly out of cash. The story had been for a long time that these companies had so much cash they can internally finance their growth. And then investors started scratching their heads. Well, if they have so much cash, why are they going to the debt markets? Sometimes issuing debt is more effective and more efficient. They still have plenty of cash. There are a couple outliers. Oracle's story is a little bit different than many of the others. So there are perhaps some different concerns there. But generally speaking, what we were doing was trying to refute the concern that companies issuing debt are now in some sort of dangerous position. That's just not true when we look at the data.
Yeah, great points. And that is a key chart to look at. Let's talk about some of the other factors that could potentially weigh on investor sentiment and the market trends in 2026. We will have regime change at the Federal Reserve, but we already know the Fed is going to be more dovish as long as the labor market holds up. Do you think that interest rates matter as much as they potentially used to in the past, or the fact that do you think that investors have come around to the fact that maybe we'll get another cut or two this year, but the general trend is down and to the right for rates, and that's not what's most important right now in investors' minds?
Yeah, so interest rates will always matter. They will always have the potential to move markets, especially if we hear an about face or some sort of pivot from the Fed, or if expectations aren't in line with what actually happens with Fed movement. But this year, I think what's more important is really the politics of the Fed. And I don't mean the Fed's argument with the administration or any of that. I mean the idea that the chairman is changing in May. We have a number of seats that could be moving around. There are still some open items, the Lisa Cook trial, all of that going on. There's a lot of moving pieces with the Federal Reserve and monetary policy that might not even be sorted out until late spring. So this first part of the year, for a few months, we're sort of sitting and watching what could happen and who might be leading and how strong their voices are at the Fed, and trying to set our expectations for the rest of the year. And that's why I think you're seeing interest rate expectations and the expectation for a cut actually continue to get pushed back. So we've got pretty low expectations for that next cut until about April, early summer, really. And that could be because we're waiting for the next chairman to come in. The other thing that we haven't talked about yet in this conversation, and that really hasn't gotten talked about much at all yet, is midterm elections happen in 2026. So not only do we have some moving pieces at the Fed and for monetary policy, but we've got a lot of political volatility that could heat up in summer and into those midterm elections. Midterm election years don't tend to be great years for the market. There's usually a lot of intra-year volatility. The drawdowns tend to be larger in midterm election years than in other years, which is why sectors like staples and healthcare found it into our list of interesting spots.
Yeah, and listeners and viewers of the Express know we've had Sam Stovall on here recently and others talking about what you usually get in a midterm election year. But we are year 4 of a bull market, and bull markets that run this long tend to continue to run, but not without a few stumbling blocks. Let's talk about the labor market, because I think it is front and center to the AI conversation as well. Productivity, and as we've seen with a lot of these big companies, one of the most important ratios is their revenue per employee. That means they're getting more out of their employee base, and we've seen a lot of layoffs in big companies over the past year or so. How important is the labor market and the sensitivity to the unemployment rate if productivity gains continue to increase, but job gains continue to slow?
Yeah, this chart is really telling, and it looks a little bit erratic, but that's just what the data says. So I think that's really the important takeaway here. The magenta line that we're looking at is the unemployment rate. The reason that there's a dash between the end of the solid line and the dot is because we don't have data for October. So it just shows basically that we've moved from September to November in the data. But the unemployment rate ticked up to 4.6%, which is higher than what the Fed expected it to be at the end of 2025. That is slightly concerning. On an overall basis, 4.6% is still very, very low unemployment. And even what we would call frictional unemployment, there's always some level of unemployment that exists in the economy. But it is inching its way toward 5%. And I think that's a place where investors would get pretty nervous if the unemployment rate rose to 5%, especially if we haven't gotten more indications of rate cuts on the way there. The other important takeaway from this chart, if you look at the teal sort of colored bars, even just eyeballing this, those teal bars were pretty decidedly and stably above zero for a long time. And that means that we've been adding jobs pretty consistently through most of 2024 into 2025. Then you look towards the end of this chart on the right side, and those bars get a lot more erratic. Some of them are negative, some of them are positive. It's hard to set expectations in an environment like that. And then you've got the average line, which is the blue dashed line. That's just the 3-month average of jobs added, coming down also pretty decidedly. That's what the Fed watches. They watch a 3-month moving average of jobs added. In order to keep the labor market stable, keep the unemployment rate as it is, we need that number to be, let's say, somewhere between 50 and 75,000 jobs per month. We are below that right now. So it is concerning in this current state. We're not in a bad place. We have not tipped over into a concerning place, meaning recession is coming, but the labor market is less strong than it was a year ago. And this is likely to be a hot topic in 2026 for the Fed.
Yeah, the replacement rate, that's what the Fed calls it. We're just not replacing the jobs that are leaving the labor market. Some of that's immigration related. Some of that is the fact that companies were holding on because of economic uncertainty. But you're right, that is a trend to watch. All right, well, last big one, margin debt. This is one that I love that you point out. We don't often think about this, and investors don't like to think about this too much because it gets a little scary. But margin debt is one of those indicators you're watching closely. Why?
Yes. So, and I want to be careful here. There have been, if you're on social media, which I'm sure many people watching this are, there have been scary things posted out there that margin debt is higher than it's ever been as dollar amount, which is true. A better way to look at margin debt is as a ratio to something else, because that makes it a little bit more applicable and comparable to previous periods. Because generally speaking, numbers rise as time goes on. Dollar amounts rise as time goes on. So saying margin debt as a dollar amount is higher than it ever was is true, but is not necessarily a good way to gauge how scary it should be. This is showing us margin debt as a percent of M2. M2 is a measure of money supply, basically the liquid things that either are cash right now or can be readily converted into cash, checking accounts, money market funds, that sort of thing. So if you look at margin debt as a percent of M2, and remembering that margin debt is basically investors buying stocks with leverage, buying stocks by borrowing money. So we see this amount rising. It's let's call it 5.5% right now as a percent of M2. Now that's high compared to history, still not as high as it was before the financial crisis, definitely not as high as it was before the dot-com bubble. This is one of those indicators that I'm not saying that this isn't a problem. This is definitely something we should watch. You can see that we have the line even shaded red where it's crept up to where it is right now, but I'm saying not yet, right? Is it a bubble that's inflating? Perhaps. Is this one of the indicators that will tell us that? Perhaps. Is it at a point yet that it looks like it's supposed to be popping? I don't think so. So that is the major theme of the outlook this year. Will this continue to rise? I would expect that it will. And while it rises, I would expect that the market continues to rise as well. Usually those two things are correlated. So this is something we're watching. This is a measure of investors taking risk. And as it rises and gets a little bit more unwieldy, that's a measure of investors taking excessive risk. And that's usually what precedes a bubble popping.
Yeah, great indicator. One we will watch closely, and we'll look for your notes on that. Arcade, we can't let you go without getting Liz Thomas's term for the week. And you're always so good about giving us one really smart term to focus on. What are you focused on right now? What is the term of the week for Liz Thomas and SoFi?
Well, one of the things, this is a term that I think everybody will understand, but as we start the year and we're thinking about outlooks from everybody out there, the term that I wanted to focus on is consensus. And a lot of times when everybody thinks the same thing, you have to start scratching your head. A lot of analysts out there, a lot of strategists are reasonably bullish going into 2026. I wouldn't say everybody is as bullish as they were last year, but they are bullish going into 26. And a lot of the S&P price targets are kind of hovering around the same level, suggesting a return of somewhere between 10 and 15% on the S&P. Now, the S&P returned 16% last year and well over 20% in the 2 years before that. So 10 to 15% would actually be lackluster compared to what we just experienced, but it's also just right in that average range. So I would always be a little weary when everybody is saying the same thing. And that's when you start to nitpick and try to decide, all right, where are the nuances in all of these outlooks? Where can I find opportunity that maybe isn't what everybody is saying? And be careful not to plow your money into the places that everybody is talking about, or the ones that perhaps have won and really led the race up to this point. I think this is a good year to diversify and a good year to have a portfolio that doesn't sound and look quite as consensus-y.
Yeah, great point. And as you noted in your note, look for the companies that are cash rich. Look in the different sectors that didn't necessarily participate, that could participate. Again, that's healthcare, materials, and staples. But all those indicators that you point out, really worth watching. We so appreciate your expertise and your term of the week. Liz Thomas, the head of investment strategy at SoFi, folks. We'll link to her research in our show notes, but follow her and her team on the socials and on site. Thanks so much for joining us, Liz. Good to see you, my friend. Happy New Year.
Thank you. Happy New Year to you.
All right, Liz Thomas here with a great outlook for 2026. And I just love the way she puts it in plain English for us. She's a great user of those investing and finance terms that we love on Investopedia. So drop a note into the comment section here on Liz and the great stuff coming out of her team at SoFi. All right, let's get into some of these headlines because the world order has certainly changed, obviously, with the U.S. invasion of Venezuela at the end of last week. And Why is all of this happening? And if you listen to any of the press conferences from the administration over the weekend, it's really about oil. And Venezuela has the largest oil reserves on the planet. They're one of the founding members of OPEC. They got some 304 million barrels of a billion barrels of discoverable oil in Venezuela. But production in Venezuela over the last decade has really been almost cut in half, if not more. A lot of that is due to corruption. A lot of that is due to the degradation of plants. A lot of that is due to the fact that we just didn't know too much about what was happening inside the Venezuela oil market. So you're wondering why the U.S. Arrested president of Venezuela and his wife, and why the U.S. is moving in on Venezuela. Just listen to the press conference, but look at oil. There is a lot of opportunity for oil companies in Venezuela. And as the president said, we have big oil and some of the greatest oil businesses in the world, but only one of them really does business in Venezuela, and that is Chevron. And Chevron is interested, as well as the rest of the oil companies in the world, in this area in Venezuela called the Orinoco Basin, where there's some 500 billions of barrel apparently that have yet to be discovered. That could be enough oil for several decades if we continue to use fossil fuel at the levels that we've been using it. The thing is, we just don't use oil as much as we used to. The demand has not been that strong. That's why prices have not been rising, even amid all of this economic uncertainty and geopolitical uncertainty. Oil prices have remained relatively stable and are still relatively stable today after this invasion. When you look at the companies that are involved, again, Chevron has the only presence in Venezuela right now, but they operate with a very interesting debt for oil production financial mechanism in Venezuela. They don't actually profit from it. They're using their oil production in Venezuela to pay off some of the debt from some of Venezuela's oil companies. And Chevron has been an underperformer among the big oil majors over the last 5 years. Shares popping today, obviously, on the news of the invasion, first trading day since we got that news. But Chevron is the key player there. But if you read a lot of the press and a lot of the reports on the future of oil production in Venezuela, it is going to be complicated, it is going to be expensive, and it is going to take a very long time. And the end result is not certain at all. But the other thing that Venezuela is very rich in are rare earth minerals like bauxite and others that we need for industrial production of semiconductors and other equipment. So this is not about democracy. This is not about necessarily stemming the drug trade coming from Venezuela. This is about oil, and this is about rare earths. And the companies that are close to this could benefit, but it's going to take a very, very long time for this to play out. All right, let's get to a little money in motion as we roll on into the new year. Let's take it away and see what we're looking at coming down the line. It's all about ETFs, and 2025 was a banner year for exchange-traded funds. We talk about it a lot on this show, and we had several guests throughout 2025 talking about the rise and the continued proliferation of exchange-traded funds. But exchange-traded funds in 2025 had a bang-up year, about $1.5 trillion in inflows into exchange traded funds. Now, some of that was the conversion of mutual funds into exchange traded funds, which have lower expense ratios, are a lot more nimble. They trade throughout the course of the day. But there was a ton of issuance of new exchange traded funds, a lot of those in fixed income. And fixed income exchange traded funds had a great year in 2025. This is a trend we're going to be watching pretty closely as we go through 2026 and beyond, because those folks that are in the exchange traded fund industry, they think that we're going to go from 12 trillion or 13 trillion in assets under management to 20 to 30 trillion over the next 7 to 8 years. And they're going to continue to issue ETFs to meet investor needs. That said, when we ask our readers, Investopediacs, what ETFs do you own and which ones do you buy today and hold for the next 10 years? It's the big ones. The biggest of them all, VOO and SPY, of course, from State Street Global Advisors, that represents the S&P 500. VOO does very much the same thing. VTI from Vanguard, the total stock market index. QQQ, obviously, from Invesco, their huge NASDAQ 100 ETF. These are the ones that investors concentrate in, yet there's more ETFs coming onto the market and more asset flows coming in to exchange traded funds. This has been a revolutionary product, even though it's about 30 years old, but the growth continues apace. All right, let's get into what to expect on this first full trading week of 2026. What's coming on down the tracks? We got some economic reports to focus on this week, including a jobs report. So what to watch this week? Well, we're watching the markets, the first full trading day since the U.S. invasion of Venezuela, and markets are relatively stable to kick off the week. We'll get some PMI manufacturing reports today on Monday, but the action really begins. ISM manufacturing report for the month of December comes today. The action really kicks into full services on Tuesday with the S&P services PMI, price managers index there, manufacturers index. And on Wednesday, we'll get the private payrolls report from ADP. This has been one of the most reliable indicators of the labor market since we've had that incomplete and late data from the Bureau of Labor Statistics. We'll also get the JOLTS report, the job openings and labor turnover survey for the month of November. I watch this pretty closely, even though this is going to be about 2 months old, just given the conversation we just had with Liz and the focus on the labor market. How many people are quitting their jobs? How many voluntary separations are there? How many people are outright leaving the job market, and how many jobs are available out there? We'll keep a close eye on that. We'll get some earnings from Constellation Brands, Jeffries, and Applied Materials on Wednesday as well. On Thursday, jobless claims for the week of January 3rd. Again, this is a week-to-week indicator of unemployment claims, so keep an eye on that. Consumer credit for November, the U.S. trade deficit for October, and earnings from WD-40, one of the oldest companies out there with a great ticker. We'll keep an eye on that, as well as earnings from Tilray. Keeping an eye on the cannabis sector lately, given the changes in banking laws and that decriminalization report. And then on Friday, another jobs report. Finally, the December jobs report, the non-farm payrolls report coming from the Department of Labor. We'll get that for the month of December. We'll keep a close eye on that unemployment rate, which, as Liz reminded us, is at 4.6%. If that ticks higher towards 5%, we could see more than one interest rate cut in 2026, and that changes the dynamics. Plus, the consumer sentiment preliminary report for the month of January coming on Friday as well. So a busy first full week of trading in 2026. Are you ready, ladies and gentlemen? All right, let's get to our indicator of the week. And what in the world are we going to do without Warren Buffett? Warren Buffett, the GOAT, the greatest investor of all time, the former CEO of Berkshire Hathaway, stepped down his final day, December 31st. And now he's the executive chairman of Berkshire Hathaway. He'll be around, but Greg Abel has the reins over at that massive conglomerate. And if you've invested along with Berkshire Hathaway, congratulations to you, first of all, but the returns have been extraordinary. $1 invested with Berkshire Hathaway when Warren Buffett really took over that company in 1964, that has made you more than a millionaire many times over. So a 5,502,000% return since Warren Buffett took over as Berkshire Hathaway CEO, compared to the S&P 500, which only gave you a 39,000% return. That's 140-fold if you're scoring at home. And there's just a small list of the Berkshire Hathaway subsidiaries out there. And if you know Berkshire Hathaway, you know that it is a conglomerate of subsidiaries that produce cash. And one of the things Buffett taught us, among other things, was that buy great businesses that produce cash flow run by really great managers, and you will generate what they call book value. And book value to Warren Buffett, more important than EBITDA, more important than free cash flow. Book value, what's a company actually worth? And then you look at the way that Berkshire Hathaway and Warren Buffett has invested in public equity and public equities over the last 50 years. The biggest holding, of course, Apple, which he has been slimming down over the last several years, but Apple, American Express, Bank of America, Coca-Cola, Chevron. Berkshire Hathaway, a big shareholder in Chevron, and Occidental Petroleum, of course. This has been one of the savviest investors of all time, generating returns that we can only dream of reaching in our lifetime. But it's not just about the money that Warren Buffett made and about how savvy he was in terms of using float in insurance companies to generate cash flow. There is Warren Buffett and I, years ago, a few pounds heavier, of course, but in the Berkshire Hathaway offices. It was his generosity of spirit. It was his thoughtfulness. It was his witticisms, his humor, but also the fact that he has given his fortune away. He joined that giving pledge with Bill Gates and several other billionaires years ago, where they all pledged to give at least 50% of their wealth away. Well, Warren Buffett is giving 99% of his wealth away while he is alive, and when he passes on eventually. A lot of that through Berkshire Hathaway shares, A lot of that to foundations like the Bill and Melinda Gates Foundation, a lot of that to his son's foundations, which are working on all kinds of issues around the world. So it's not just the fact that he was able to generate so much money, it's the fact that he is willing to give it away to help solve some problems. And Warren Buffett's pretty savvy. He's not just a folksy, charming guy who can play the ukulele. He's a very savvy and very shrewd business operator, even though he's not CEO of Berkshire Hathaway anymore. He will be around as executive chairman, and I expect to see him at the annual meeting in Omaha in May, of course. But there's one thing about Warren Buffett. He did it his way, and he reminded us of that several times, including in this memorable performance on CNN years ago. And so for all of us here on the Investopedia Express, happy 2026. Let's get after it, and we'll throw it over to Warren Buffett to take us out this week. We'll catch you again a little further on down the line.
I've lived a life that's full and traveled each and every highway and more, much more than this. I did it my way.